Do you expect the growth rate in the economy to decline slightly?
We are looking for moderate growth in the U.S. economy going forward. And I would add parenthetically that the downward revision of the fourth quarter GDP numbers we got this morning is actually more consistent with our overall view of the economy than were the original numbers. So we expect moderate growth going forward. We believe that if the housing sector begins to stabilize, and if some of the inventory corrections that are still going on in manufacturing begin to be completed, that there's a reasonable possibility that we'll see some strengthening of the economy sometime during the middle of the year.
Will the rebound stick? That's the question facing investors today after stocks staged a comeback following Tuesday's free fall. It's been a wild ride for investors. In just the past 2 days, the Dow has swung about 700 points. In the last session, the Dow gained 52 points one day after plummeting more than 400. The Nasdaq managed an 8-point rise. Investors gained confidence after Federal Reserve Chairman Ben Bernanke said he still expects the economy to pick up steam.
And had the lead story in your newspaper this morning, Fed slashes rates to 4.75%. Why is that?
Well, the Fed's taking an aggressive step to try to head off the risk of a recession here in the US. It's worried about the spillover effects from the financial markets, particularly on housing, but potentially in the future on other parts of the economy too. So it wants to act now as a precautionary measure to try and make that very unlikely. But what we're really trying to explain in this story is why the Fed did what it did. Why did it move so aggressively, 50 basis points, or in common English, half a percentage point, not a quarter of a percentage point, as many in the markets were expecting? And the answer is that the Fed has a forward-looking risk management strategy. They look to see what could be happening in the economy. Could it be overheating? Could it be in the risk of recession? And this time they've identified a serious risk, not an expected outcome, but a serious risk that things could go badly on growth. So by acting hard up front, they hope to see off that chance.
Critics are saying this is going to stoke inflation and that the dollar is going to tumble.
Well, there's no question they're taking some risk with inflation.
Monetary policy has responded proactively to the evolving situation. As you know, the committee cut its target for the federal funds rate by 50 basis points at its September meeting, and by 25 basis points each at its October and December meetings. In total, therefore, we have brought the funds rate down by a percentage point from its level just before the financial strains emerged. The Federal Reserve took these actions to help offset the restraint imposed by the tightening of credit conditions and the weakening of the housing market. However, in light of recent changes in the outlook and the risks to growth, additional policy easing may well be necessary.
After careful consideration and after discussions with members of the Congress, I have concluded that additional action is needed. To keep our economy growing and creating jobs, Congress and the administration need to work to enact an economic growth package as soon as possible.
Following a significant reduction in its policy rate over the second half of 2007, the Federal Open Market Committee eased policy considerably further through the spring to counter actual and expected weakness in economic growth and to mitigate downside risk to economic activity. In addition, the Federal Reserve expanded some of the special liquidity programs that were established last year and implemented additional facilities to support the functioning of financial markets and foster financial stability. Although these policy actions have had positive effects, the economy continues to face numerous difficulties, including ongoing strains in financial markets, declining house prices, a softening labor market, and rising prices of oil, food, and some other commodities.
The closing bell at the New York Stock Exchange, the main index down over 7%. Shock and panic evident on the faces of those on the trading floor. Just hours earlier, they'd watched open-mouthed as members of the House of Representatives voted down the $700 billion rescue plan. Wall Street had assumed it would pass. Wall Street wanted the bailout to give the government power to buy up the bad assets held by banks and other businesses that have been clogging up the financial system.
All that being said, with the economy likely to be weak for several quarters and with some risk of a protracted slowdown, consideration of a fiscal package by the Congress at this juncture seems appropriate.
With no silver bullet for the economy, the Fed fired a shotgun blast. In slashing its benchmark interest rate to the lowest level ever, the Fed said rates were likely to remain at exceptionally low levels for some time. Bernanke and company also promised to use all available tools to turn the economy around. Translation, a Fed spending spree.
A litany of bad economic news has snuffed out Wall Street's 5-day rally as investors realize anew how troubled the U.S. economy really is. Confirmation that the nation's in a recession followed reports of only a modest gain in holiday sales. The Dow sold off more than half the 1,276 points it added during a 5-day rally. The market began the day sliding on lackluster holiday sales reports. Downbeat news on manufacturing and construction spending then added to investor concern. At midday, Wall Street had confirmation of what everyone had suspected for months, that the nation is indeed in a recession.
A lot of Americans may feel that we've been in a recession for some time, and now, according to the National Bureau for Economic Research, they would be right. That private, not-for-profit group has declared that a recession began in December of 2007.
All right. Today is Sunday, the 25th of August, and this is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. And how about we begin with this? You might have noticed that I'm shooting a lot of sort of political themed videos. For example, I gave you recently my economic plan review for the Kamala Harris campaign. And I'm just going to give you a heads up here. Expect more content of that nature, more political content. Matter of fact, the thumbnails for the videos from this point on, all the way till November, will be just a picture of the two nominees. And the goal here, they say, that by November, the two campaigns would have spent over $500 million in political ads. Now, a lot of this money will find its way into YouTube. And you know what? I want a piece of that. I want my taste out of the $500 million. You're gonna spend it. I want a piece of that ass. So I'm going to trick the algos here of thinking that every video that I'm putting out has something to do with the elections. So I can trick the algos to place these really expensive ads and get a piece of the 500 mil. But you got to help me out here and click on these videos. Otherwise, we're just going to make $2 out of those $500 million. But folks, if you happen to be a member in the channel, I gave you another bonus video today, which is viewers' comments. And I call this sentiment indicator because it is spot on all the time, never fails. And in this video, we went back to the sentiment before the top in July. And you guessed it, the bulls were overly euphoric, while the bears were pussying out and complaining and bitching and whining, and this is just going to continue forever. I'm going to capitulate and buy right now. And immediately, of course, we go down. Now, in the next installments of these videos, we'll do the sentiment indicator back when we got baby volume getting, is what I call it. You know, when the Japanese yen trade was ongoing and everybody was shitting their diaper in the morning. Because the sentiment is really interesting. The bears were saying, okay, this is it. We got it, baby. We're going to crash from this point on. And the bulls were saying, hey, Maverick, you know what? You're finally right. After all of these years, you're right. Now we're going to get you a crash. When I heard that, I said, okay, we're not going to get it right now. Matter of fact, we said, and the outlook was that the odds for a rebound at that time were a lot higher than a continuation of the drop. Then, of course, we'll do a video for the sentiment, what it looks like right now. Well, I'll give you a hint. It is closer to the sentiment that you have in that video that I just released. Or the bullish euphoria is beginning to creep in again. See, we went down, we came back up again, and now we're going to make the highs, and better highs. And the sentiment among the bears, of course, goes back to the same point it was in July. As in, okay, here we go, another drop, nothing happened, higher we go, you know the deal. They're never going to drop the market before the elections. And these sentiment indicators are really important because they give us a valuable piece of input in the collective puzzles that we have to collect every single week to read the market better, to figure out the market and make moves based on the collective evidence. We'll talk about that a lot more, folks. But let's begin here, this video, because in the title we say the Fed made a serious admission. Of course, this week we got Jackson Hole and Jay Powell came out and the media came out after him and said, you know what, this is the confirmation for the rate cuts. The market loved it. Everybody lives happily ever after. Well, maybe not, because once you read in the details, the Fed made a serious admission, and that admission is, yeah, we're cutting rates exactly for the wrong reasons, meaning that the odds for the soft landing they've been selling us. The Federal Reserve made an admission that these odds are dropping like a rock. And that's important. And that changes the game from this point on. Let's take it one step at a time. We usually begin with the wall of hope, but this time around, we're going to begin with the wall of worry. This week, certain items are beginning to come back in play. Others are fading away. Let's begin with the ones coming back in play. And that comes from the election risk. And I'm going to keep Joey B here because, in my book, he's the legitimate nominee. And he was taken out. So in empathy to Joey B, I'm going to keep his face here because it's also easier not to edit the whole picture again and shove in Kamala. But anyways, why is this coming back in play? Well, the reason is we'll see a change in the polls coming out really soon. If you recall what we talked about in last weekend's video, the market doesn't really care whether the president will be a Republican or a Democrat. They're all going to work their asses off to pump the stock market higher. They're all in the pockets of Wall Street. But the market wants a certain outcome that it can play and adjust the moves based on the policy, or shall we say, the expected policies. And so far, it's been Kamala Harris leading the polls by far. Well, now the gap is closing. I think it'll close more. Of course, we have the debate coming out. We have, let's say, the sugar high from the Chicago DNC convention is now fading away. And now, instead of the theatrics and the fake enthusiasm, we got to talk about something serious here. We got to talk about some serious issues, including what we got this week, which is the jobs data revisions. Over 818,000 jobs, poof, gone. Why? Because they were fake to begin with. There were no 818,000 jobs. And by the way, this is the Cook number. In reality, we probably inflated jobs by over 1 million. But this is the cook of the cook within a cook. It doesn't matter. The bottom line is the employment picture in the economy is not as bright as we thought before. And now we begin talking about the economy more than the other bullshit issues. And guess what? Recently, the Republican campaign sharpened the attacks against Kamala Harris when it comes to the economy. Maybe you'll see the newest ad when you're watching this show, but they're talking about Bidenomics now and tying what Kamala said before, what she's pitching right now. I think that's more effective. And the other catalyst, besides the fading away of the sugar high and the new ads by the Republicans, we also have the suspension of the campaign by RFK Jr. Now he endorses Trump instead. He says he's not going to drop out, his name is going to still be there, but point being is whatever vote he was getting, the folks who were in the Democratic side were voting for JFK Jr. because they didn't like Biden. Now that Biden is out, they went to Kamala Harris. Now you got the Republicans who are not happy with Trump, the ones left with RFK Jr. By him going out, I think that Donald Trump is going to gain about 1 to 2 points, at least at the polls. Now, you combine it with the other factors, and I think that he's going to take the lead, and then we'll see what happens with the debate. We'll see what happens in the October surprise and what happens with the stock market and the economy. I think that's going to dictate who wins in November. But the point being, if he's going to come back at the polls, maybe, if you look at the stock of DJT, now this is the Trump media stock, he's going to dump pretty soon, so it's not something you want to buy and hold, but it works based on the sentiment and the numbers at the polls. When he began to drop, the stock went down. Now as he comes back, my hunch is we might see another rally in this stock before he dumps, cashes out, and say goodbye. He goes back to Twitter and X, whatever I want to call it. And then they wrap up the whole truth media scam. In any case, back to the wall of worry. So we talked about the election risk coming back just a little bit. It's about to heat up now that we have the debates coming out. But he got 2 items in the wall of worry that cooled off, faded away a little bit. And that's, of course, number one, the geopolitics, no longer important. We got the response by Hezbollah overnight. And it was lame, to say the least. Of course, we have more responses coming from Iran and from Yemen. Of course, we'll see what happens with those, but this was the more anticipated one. And of course, in the fog of war, everybody makes up their own reality. On the Israeli side, they say that they did a preemptive strike. They caught the attack before it happened, and they shot and destroyed thousands of missiles early in the morning in Lebanese territory. Now, anybody with half a brain knows that this is all bullshit. They didn't really destroy thousands of missiles. On the other hand, you got the story from the side of Hezbollah who said, no, it's actually Israel lying, and we hit every target we wanted to hit with extreme precision. 100% accuracy. Everything we wanted to achieve was achieved. Of course, anybody with a brain knows that this is bullshit, so the truth somewhere in the middle. Or probably the scale of the attack was much bigger than it is, or at least what we saw. And the Israelis caught some of it ahead of time, and maybe they shut down 60 to 70% of the attack. But then you got 30 to 40 that already passed and delivered. So that's probably the reality, but doesn't matter what really happened. Doesn't matter what really got hit or not. The bottom line that we got from all of this theater is both sides are not interested in escalating. They don't want to go to war. They're scared. They don't want to do it. But there is no deterrence either. Meaning, if Israel thought that the bombardment and the assassinations will somehow deter the enemies, well, good luck with that, because now you have 7 million enemies. You used to have one, now you have everybody shooting rockets at you. So much for deterrence. On the other side, too, this attack by Hezbollah is not going to stop Israel or deter it from assassinating anybody they want to assassinate. Doesn't matter whose territory. Iran, Lebanon, Iraq, Syria, doesn't matter. So we now live with the potential that it might happen again, it might flare up again, but for now, they're done with it. That's it. And the anticipation, the expectations, the fears begin to fade away. Now, what are the implications in the market? Of course, you'd think that maybe now that we got a clear signal that both sides, they don't want to go crazy in full-scale war, maybe oil should be down. But I doubt that. I think that oil will be higher. And the reason is oil is now more in tune with the recession story and the monetary policy, the rate cuts. It is listening to the geopolitics, but it's been already factoring in that we might have a ceasefire agreement, and oil was going down ahead of time. So I don't think we're going to have a negative impact on crude oil, but we might have a negative impact on the defense contractors, the Lockheeds, the Raytheons of the world. If you look at the chart of RTX, Raytheon, for example, maybe we have a rising wedge pattern. And now that we bought the rumor of the retaliation, now we're going to sell the news of the retaliation, and we see a pullback in Raytheon. That's going to be an opportunity to buy. Maybe not right away, but let it play out, and then you buy the dip in Raytheon, because this is not going to stop, be it the Middle East war, be it the Russia-Ukraine theater. And by the way, all of these missiles from the Iron Dome, somebody has to replenish them. By somebody, I mean you and me, baby, the U.S. taxpayer. Well, we're going to pay Raytheon to do it, so that's going to be good for the stock from a fundamental perspective. And this is how I look at it. Very little impact on oil, but maybe an impact, negative one, on the defense contractors, be it it's going to be an opportunity to buy the dip at some point. Let's go back to the wall of worry, because we have another element that pretty much eliminated for now. And that is the Jerome Powell no deal thing. Everybody was afraid that maybe he's going to be more hawkish than expectations. I was certainly in that camp, that he might do the 25, but nothing much. Matter of fact, I thought we might see the comeback of Mr. Payne from the year 22, Jackson Hole. Remember when he said this?
I'm not cutting rates, you lazy bitches. Sell your stocks and close the fucking door. Thank you.
But no, Mr. Payne is not back. Matter of fact, he said, Chairman Powell said that interest rate cuts ahead. The time has come for policy to adjust. Okay, this is not new. We all anticipated that. We all know that the Fed will cut rates in September. But the better odds were for 25 basis points, and then we see what happens. Now, we got to understand that before Jackson Hole, and we discussed this in the video right before Jackson Hole, that there is a road to impossible here, which is the market psychology. On one hand, now that we're nearing the rate cuts, that the rate cuts become reality, the market doesn't want to believe that the rate cuts are happening for the wrong reasons, meaning a recession. And every time we get an evidence that, no, we're not heading into a recession, we've seen the market going higher, because the market was treating good news as good news, and it was seeking good news, that there is no recession, and there are no rate cuts because there is no need for them. Of course, the recession data doesn't stop rolling, be it from the earnings side, be it from the macro side. That's not going to stop. The reality is the economy is slowing down and getting weaker by the day. We see elements of the consumer. We see elements of corporate America, of retail businesses falling apart now. We see distressed debt also beginning to show signs of weakness. So the other cake that the market wants, wants the cake, eat it too. The other cake is, look, if there is a recession, if it becomes evidently clear that there is a recession and this is why we're cutting rates, we want to know that the Federal Reserve is going to cut aggressively. They're not going to do the 25 and be careful and data dependent. They'll go crazy, guns blazing, bazookas, 75 at a time, 100 at a time. That's what the market wants to see. Otherwise, you can't really please the market. And I think that maybe the interpretation of what the market wanted to hear from Jackson Hole is, yeah, we got both. But most importantly, one door, one cake is disappearing, which is the assumption that there are no rate cuts because there is no recession. That's fading away with the mounting evidence. And now there is a new source of hope for the market to hang its hat on. That okay, no biggie, recession might be a risk for now, a big risk that is real to the economy. At least the Fed will be aggressive and take care of it before it becomes a major problem. What was the phrase by Jay Powell that gave the market that assessment that, yes, this is good? Because the moment he said this, we've seen the market going higher in a rotation, not just any rotation, but the risk-on rotation. Talk about the profitless companies, the small caps, the IWM, the regional banks. All of the companies under stress began a rally, while on the other hand, we've seen a pullback in the bigger names, which are considered safety. The big caps, the chips, they faded in favor of the risk-on rotation. And it came after this phrase exactly. Take a listen.
Do not seek or welcome further cooling in labor market conditions.
JP says that he doesn't seek any further cooling in job market conditions. Let's translate that a little bit and unwind it. On one hand, he's bullshitting. He says no further cooling. It's not cooling, pal. It's falling apart. So he's saying, I don't want to see more weakness here. It might get out of hand. And when he says we seek no further cooling, aka we're shitting our pants, and we will do whatever needs to be done at this point to stop the unemployment rate from going higher. If that means going from 25 to 50 instead, or even from 50 to 75 basis points, so be it. We'll do it. And the market took that as okay. We'll just go with the Fed right now. You see the headline here. Fed chief signals in Jackson Hole that weak August jobs data would punch ticket for half-point rate cut. And that's really important because you look at the odds. Throughout the week, when the odds for a 50 basis points cut in September went down, the market went down or stalled. It didn't really care that the odds for 25 basis points were going higher. In other words, this is evidence that the market right now is seeking more rate cuts. The 25 alone ain't gonna do it. And the no rate cut optimism is now gone because the market has faith and finally believed that there is reality to the risk of recession. And now even the Fed admits that, which means that forget about the soft landing for now. And forget about, oh, the economy is fine, so we're not going to get rate cuts. We're going to get them. But the market says, okay, but we're going to get more of them. And that's going to avert the recession risk again. So I'm happy. Let's go higher. Matter of fact, let's do a risk-on rotation. So we go back to the wall of hope. It's no longer no rate cuts. It's actually back to rate cuts again. But at some point, we're going to have another problem, which is rate cuts 25 or 50, not going to be enough. In the market right now, the source of optimism will be looking for more rate cuts, which could run into a wall. The Federal Reserve might not have the ability to satisfy the market's need of more rate cuts, not just 50, but 75 and 100. Gee, why would that be? Let's take it one step at a time. Let's begin with inflation psychology. It is really imperative that we understand inflation psychology before we understand the recession psychology that we're shifting to right now. From inflation psychology to the risk of recession psychology. We begin with the inflation psychology. It begins as when we begin to see the risk of inflation. The market dismisses it as, oh, it's going to be transitory. The Fed says it's going to be transitory. Elon says it's going to be transitory. That was, let's say, late 21, the third quarter of 21. And then comes the evidence about the fourth quarter of 21 that no, it's not going to be transitory. And the Fed will have to respond by increasing rates higher. The market stalls. Late 21 begins to trade down. Then the market wants to see it to believe it. And the Fed delivers with the first hike. The market doesn't like it. That's 22 now. It begins to look ugly, but then the market goes with, okay, maybe this is the last one. We got a piece of data in the CPI, came below expectations, whatever bullshit you want to plug in. And the market says, okay, this is the last one. They're going to do the last hike and that's it. And the market goes higher. Case in point, the summer of 22, we got a bear market rally. Then, of course, comes a piece of evidence or zombies from the Fed talking. And they say, you know what? Maybe we need more interest rate cuts. And the market doesn't like it. And it flushes down. And that was Jackson Hole 2022 when Mr. Pain came out and said, no, you got to prepare for more pain. We're not done yet. Okay, the market goes down, but it finds another source of optimism that at some point they're going to pause. We're looking for signs of rate hike reduction from 75 to 50 because once that happens, then the next step would be 25, and after 25 we pause. So we got pause optimism. And that was, let's say, Q4 of 22. Then comes Q1 of 23. And we have rate cut optimism. Why? Because we got the regional banking crisis, the collapse of SVB and the likes. Now the market says, okay, maybe an idiosyncratic problem in the banking industry. And now the Fed will begin to become more accommodative and cut rates. So I'm going to run with that. That's my source of optimism right now, that the Fed is going to cut rates at some point. Now, with that understanding, let's see how recession psychology works out. In the beginning, you get a shock because the assumption so far has been, we got a soft landing. And that happens all the time. Back in 07, 06, they said the same thing. We're going to have a soft landing. Verbatim. That always happens because the Fed, of course, overestimates its ability. They think they're gods. And they say, oh yeah, we have inflation, we got it down with interest rate hikes, and now we're going to avert the recession risk by cutting rates. That's going to do it. Every time, pretty much, it fails. Few exceptions here and there, but for the most part, it fails. And the economy heads into a recession either way. But it began in stages. The shock is, for example, what we got during the baby volume getting, the Japanese yen unwinding trade phenomenon. And by the way, let's be honest here. Do you really think that that crash was due to the Japanese yen rallying based on a mere 25 basis points hike by the BOJ? Well, you gotta be a fool to believe that. That's gonna be the reason alone. It wasn't. It was part of it, but it was already old news. Part of the reason why we've seen an explosion in the Japanese yen is the recent decline in the US dollar. Well, gee, why did the US dollar flush down? Of course, we got recession news from the unemployment data. The important finding is that any weakness in the dollar now pushes the Japanese yen higher and causing a mechanical risk to the stock market by initiating margin calls in the big caps. They're connected. You don't want to see the dollar going down in a big way. I mean, it is flushing, dropping like a rock right now. And the more it goes down, the higher the Japanese yen will go. In any case, since the reason behind the shock is actually recession, not really the Japanese yen, we move on to the next step, which is no recession optimism. That was the last couple of weeks. And the market gets any piece of data from, let's say, the earnings of Target or Walmart, or any piece of data such as the services PMI, or the lower CPI, or the beat in the retail sales data allegedly, and says, okay, see, there is no recession risk at all. We don't care about the rate cuts anymore. We don't want them. We are still good to go here. And then, of course, the recession data doesn't stop. It keeps coming in, coming in, coming in. And at that point, the market says, okay, no problem. I got another trick up my sleeve here. If a recession is reality and it's unavoidable, and this is why we're doing rate cuts right now to get a better outcome, be it a mild recession or averting recession, perhaps. Maybe if we do more rate cuts with more aggression, we get the job done and we avert a recession and the rate goes down and we see expansion in the economy. So we go to the next source of optimism. Okay, recession, but no rate cuts. And the impact, of course, is what we've seen in the market this Friday with the rotation back into the IWM and the KRE and the risk-on segments. What the market doesn't realize is the Federal Reserve just admitted that there is no soft landing, so you're not going to play that game, but the market is playing it anyways. The problem is, once again, the recession data is not going to stop, and the promise of a rate cut, be it 25 or 50, ain't going to do it. And even if it happens, it will take a long time before that feedback is felt in the real economy. So what's going to happen here? Moving on to the next stage, which is more. Now the market wants more. The 50 is not enough. We want to do 75. We want to do 100. And sometimes the Fed is not going to be able to be that accommodative because it might be too risky when it comes to reviving the inflation risk again. And so long as the market is looking for more, but the Fed is being cautious, more than the market. Maybe the Fed is pricing in 50, but the market is pricing in 75 or 100. That becomes disappointing to the market. We see it going down, and hence the sustainability of the rotation is under question. More on that in a minute when we talk about the strategy, but listen to this right here, which will let you know why the rate cut optimism will fade away. The headline reads, a recession is coming in the U.S., and a few rate cuts won't prevent it, says a strategist. They pointed to signs of the economy slowing down, including what he called the deteriorating U.S. labor market. That's a quote. The U.S. Labor Department reported that the unemployment rate inched to 4.3% in July, its highest since October 21. And a gauge of U.S. manufacturing activity fell to an 8-month low in the same month. There is things that are breaking down quite rapidly now, said the strategist. A few rate cuts are not going to prevent a recession. Average recession is 10 months. It takes something like a year before Fed cuts actually start to give boost to the economy, he said. And I say amen. I mean, look at how long the hikes took to show up and tackle inflation down. You think the rate cuts will just show up the very next day and the economy is going to recover and everybody's going to be able to pay their credit cards and auto loans? Of course not. Anyhow, the market believes that the Fed funds rate at the end of the year will be 3%. It is currently at 5.3%. That will not happen. Listen to this. That will not happen unless there is a recession, he added. And I say amen. A recession typically occurs when there are 2 consecutive quarters of decline in the country's real GDP. Again, GDP is bullshit, but that's going to happen. The U.S. economy has remained robust. I don't like this word, robust when it comes to the economy. I mean, when it comes to food, marinara sauce, that's robust. Your asshole, that's robust. But the economy cannot be robust. The economy can only be bust. Anyways, he says the economy has remained robust, even amid ongoing inflation and elevated interest rates. In the last century, there have been more than a dozen recessions, some lasting as long as a year and a half. Although the U.S. is not officially in a recession. Listen to this. A survey conducted by a firm reveals that about 3 out of 5 Americans think it is. That's the crowd who's doing buy now, pay later, or never. That's what they thought. Now they know that you got to pay. Otherwise, they're going to shoot you in the head. So now we know that rate cuts alone are not going to do it. You need to do them aggressively, 200 basis points, which the Fed cannot afford to do with the inflation risk still on. And on top of that, it takes a long time to remedy a problem that's going on right now in the economy. It takes time till we see the rate cuts really impacting the economy. But rest assured, the sadness in the market might not last for too long. We might actually have a nice rebound after that, because we will have another source of optimism called bailout optimism. If you recall, of course, all of the rate cuts that the Fed began in September 2007 didn't do shit. The market was going down. Well, comes the first quarter of 2008, and the Bush administration, the fiscal responsibility bullshitters on the right side of the political aisle. But when it comes to Wall Street and bailing out the market, of course, they have no problem spending billions of dollars. And that's what the Bush administration did. And we got some bailout optimism. We got a little bit of a bounce, 5%, 6% rebound. But then the bailout optimism doesn't last for too long. Because now we got a problem. We got inflation coming back. And that's going to be restrictive to the Fed in cutting rates as aggressively as anybody wants them to, or will want them to, which means that the recession risk will also go higher. And that's when things begin to blow up, things get out of control, and we have the game over. The stages of denial. There's acceptance at the end. We'll talk about this a little more, but before we do that, we have to go back in time and revisit the GFC episode. So we know in June 2006, we got the last rate hike, and the Fed was signaling rate cuts to come. Here comes the rate cut optimism. We see a huge rally. 2006 into 2007. We got bad economic news, but the market didn't care. The market shook them off. And this was before Taylor Swift. She was a baby back then. And the shaking off was only permissible because we have rate cut optimism. Whatever problem we have with the economy, the Fed is going to fix it. Here comes September 2007, and the Fed cuts rates not by 25, but by 50 basis points, because the market threw a fit when it was 25. So then we got the 50, and 50 was okay. We got a rally based on the 50. Okay, now we got the 50, and that was the top right after. Why? Because comes October, immediately after the 50, the Federal Reserve realizes that the inflation risk is too real. And if you do the 50, you're going to bring back inflation. So they downgraded the pace of interest rate cuts from 50 to 25. Of course, the market didn't like it. It threw a fit because the market wants more now. So the Federal Reserve, of course, since the real mandate is the stock market, pumping and propping up the stock market, the unemployment mandate and the inflation mandate, the price stability, all of that is just cover. It's bullshit. The real mandate is propping up the assets of the wealthy in this country, stocks and real estate. So the Fed says, okay, let's do 75 now. We're going to go from 25 to 75. Well, the market likes it for a little bit, but now the market looking for 100 basis points rate cut. The problem is inflation is coming back. Just do your own research. What happened to oil prices in the first half of the year in 2008? So the ability of the Fed to continue to cut rates, that was over now. And the Fed actually pauses interest rate cuts April 2008, and the market begins to flush down in a big way. Now we need another bailout optimism. At some point, reality hits the acceptance stage, and we have the game over stage. And your homework right now is work with the 07, let's say 06, all the way GFC timeline when it comes to the S&P 500, and plug in oil. Study how it worked out vis-a-vis rate cuts and the promise of rate cuts and all of that, the changes in policy. Now you notice something important. Well, what I'm going to do for you here is plug in the dollar in green, gold in yellow, of course, and then we have the MOV, the bond volatility index, I guess in white or gray, whatever the hell that is. What you can't see clearly is there was a stage when the dollar was going down, the stock market was going higher. That's the rate cuts optimism stage. But there is a change when the dollar continues to go down and the market goes down with it. We see gold rallying and we see bond volatility moving higher. That's when the market shifts toward, okay, the dollar is going down for the wrong reasons, aka rate cuts are coming for the wrong reasons, and I shouldn't be happy about that. It's really, really hard to please the market once it enters this stage. Now you gotta remember, before the rate cut in September 07, there was a major correction. It was followed by a sharp bounce. We actually made newer highs, and that was the top, and then we went down in a crash after the rate cut. So whatever we're doing right now in the market today, it looks eerily similar to the days preceding the GFC. Now let's digest this a little better, because we talked about a lot of things, but the conclusion is the market came out with the impression Friday that recession is reality, but the Federal Reserve will give us more rate cuts, and that's going to do the job. So we go back to the risk-on optimism, the soft landing optimism, that yes, recession is reality, but manageable by the Fed being aggressive as we need them to be. And that's so far so good. I'll give you my strategy in a minute. But before we do that, let's talk about the problems that we could run into. And really soon, by the way, because that's going to derail all of the optimism. And problem number one is the dollar Japanese yen. If the dollar continues to weaken because anticipation of rate cuts and more recession data, then the Japanese yen is going to rally to a point where, again, triggers all of these margin calls of the big cap technology stocks, impacting the major indices in the US market, the S&P and the NASDAQ. And the other risk, of course, is what we talked about. We'll talk about a little more. It's the inflation risk coming back. We've seen how that played out in the first quarter of 2008. Everybody, of course, dismisses the possibility of inflation coming back. Well, we have a recession fear. We have inflation is already defeated, they say, without the understanding that rate cuts is a stimulative action, and the feedback from that stimulation is received differently. It's usually perceived earlier by the commodities cohort, causing inflation, and then by the time it reaches stocks or the real economy, the narrative has already changed into inflation coming back. And what you need to understand here, you got your recession risk and inflation risk. Say in 22, when the inflation risk was way too high and the recession risk was low, you got an economy that continues to create jobs, you got excess savings from all of the stimmies. And all of the weakness that we got in 22 was due to sentiment, really. And my criticism, and what we're going to talk about in detail someday when all of this is said and done, there was an opportunity in 22 to be aggressive, shock and awe by the Fed, a Volcker type of approach, by raising rates aggressively to shake out the inflation psychology from the economy, while at the same time the recession risk was pretty much non-existent. You had the room to be aggressive without damaging the economy. But the Fed, of course, played the game of, I don't want to upset the stock market. That's what's really important to me. So they kept raising rates little by little by little. And of course, in time, the feedback showed up. And now the risk of inflation is way below the risk of recession. It's not completely eliminated. It is still a problem, but it's not the dominant problem. The recession risk is now more dominant. It's a zero-sum game. One's gain is another's loss. What's going to happen now by the Fed saying, okay, the inflation risk is not really predominant. The recession is, so it is time to change policy. We need to begin cutting rates. If they go aggressively, though, again, what's going to happen is reducing the recession risk. But that's going to come at a price, and the price would be increasing the inflation risk. Of course, the Fed thinks that at some point they'll be able to reduce the pace of interest rate cuts or pause, and somehow we're going to reach and find the sweet spot where we see the inflation and recession risks being equal, not being threatening to the economy. And there you go, soft landing. But in reality, what usually happens in balancing this really dangerous game is either you have the revival of both risks, the inflation risk come back up, but because of the inflation risk coming back up, which handicaps the Fed's ability from stimulating and loosening interest rates even more, we see the recession risk also going higher together. At some point, things begin to blow up in the economy, and the inflation risk is eradicated out of it, but the recession risk now becomes a reality. We actually have a recession in the economy. And the reason is inflation now has been legitimately defeated. It took recession to take inflation down. And you gotta understand all of this. Now, the other problem, of course, is at some point when we get more recession data. So we just talked about the inflation risk, the comeback of inflation. Usually that happens a few months after the rate cut. It's not the most immediate problem we're gonna face. The next one, besides the Japanese yen problem, could actually be the more rate cuts, please, or no please. We're demanding rate cuts right now, and more of them. Why? Because we continue to get recession data, whether from the employment report coming out really soon or any of the other data we're getting next week or the week after. It's a fragile and not so sustainable rebound or rally so far, because it could be derailed in many ways. But for now, we gotta play what we got. We got to do a strategy for what we got. And on Friday's session before the close, I gave you the note here in my Discord. You can pause and read all of this for yourself, but in a nutshell, we got a strategy of staying long certain names, and then we have a strategy to rent certain names, and finally a strategy to sell/short other names. The names that we're going to stay long in, that's going to be value stocks. I mean, look at the SPYV. That's the ticker. Why is that guy making all-time highs right now, while the S&P 500 and the NASDAQ, supposedly the best stocks in the world, they still did not recover the highs? But there's a reason behind that, and the reason is SPYV, value stocks, high dividend paying stocks, have been tested just as the same as the technology stocks and the chip stocks. We got rotations, we got recession scares, we got Japanese yen problems. Technology went down, Bitcoin went down, but value stocks held pretty good, SPYV. Which also, by the way, the RSP, as we talked about in I believe, last weekend's video, that I expect the RSP to outperform the SPY. Now, as you can see for the week, RSP up about 2%, SPY up about 1.4%. But we're also going to stay along the IWS. This is mid-cap value. Not as reliable as the SPYV, but it is reliable when it comes to if you want to broaden your risk into mid-caps or small caps. This is one of the highest quality plays you can do. And then, of course, dividend-paying stocks. We're going to stay with those because as yields continue to go down and the dollar goes down, a lot of these dividend-paying staples companies and utilities and all of that, they benefit from both. They benefit from the rotation out of bonds into dividend-paying stocks as the rates become more attractive. And the drop in the dollar, of course, helps multinational companies, especially those in the staples cohort, the Procter & Gamble's of the world. And, of course, the risk-off rotation. We're talking about defensive positioning and, say, utilities or the defense contractors, the real estate businesses that are paying dividend and of higher quality. Some of the banks, the JP Morgans, for example, work out in the risk-off rotation, reliable, no risk, high cash flow. All of those are okay to hold on to for now. And then you have gold. And again, gold has been tested and continues to hold on. So those are going to be long. We'll continue to hold on those. Now that we have optimism again in the market, optimism of the Fed will do the job and eliminate the recession risk. And oh, by the way, don't talk to me right now about the inflation risk. I don't want to hear it. I just want to hear the good news. That's what the market is saying. So in the meantime, with the dollar going down, with rates going down, allegedly for the good reasons, we want to have positions in oil and commodities such as copper. This is at least what I did. IWM will work out okay until we get a piece of data that says no, rates are going down for the wrong reasons or going up for the wrong reasons. But it works for now. That goes with the KRE, regional banks, the risk-on rotation, the profitless companies, the speculative plays, the biotech companies. All of those are going to perform a little better. The home builders. And then you got these cyclicals. Again, a lot of these names were going down because of recession risk. And they went down aggressively. And now the market says, but the Fed will fix it because the Fed is now open to 50, not just 25 right off the gate, and even 75. From what we heard, what we thought Powell said, and that opens the cyclical names to catch some recoveries. And this is why we added some of them in the long portfolios, such as DAL, Delta Airlines, WYNN, Wynn Resorts, and the ticker MGA for Magna. All of these businesses are cyclical in nature. So if we're talking about recession, what are you out of your mind buying this stuff right now? We are renting, baby. We got to play what the market is thinking right now. You see these plays played off. This week, you got DAL up about 3%, Wynn Resorts up about 1.5%, but it is among the outperformers in the casinos. And then we have MGA up about 4.5%. All of this might fade away really fast, but you can rent these names and set your stop loss, and every time you make a gain, up your stop loss. That way these stocks go down for whatever reason, come back with recession. Or, oh, by the way, inflation is coming back. Oh, by the way, Jerome Powell just slipped on a banana peel and died. Whatever reason it is, it doesn't matter. You got your stop loss, you lock in some gains, and you move on. And then we have the ones that we want to sell/short, and that's going to be the big caps and chips. We're beginning to enter those positions via put options. We'll expand on them if we see more signs of weakness and confirmations, which we're going to talk about in the charts analysis in a minute. But once again, why do we stay along the SPYV, the IWS value, and mid-cap value, dividend-paying stocks, the risk-off rotation, gold? Why do we stay with those guys? Because they've been tested, and they did not bend under pressure from all of the problems that we had in the last few weeks. Now, the stuff that we're going to rent for now, what is the problem with that? It requires perfection. It requires rate cuts for the good reasons, no recession, no inflation, and you're not going to really balance this out for a long time. You'll have optimism from here and there, and then it stops, and now we have fears. And we're going to sell these names again because our rates are going up for the wrong reasons or going down for the wrong reasons. And hence, We rent these names. Now, the sell category, the big caps and chips, why do we have to do that? At least hedge for now. You happen to be long. The risk here, number one, you got the rotation. Whether that's voluntary rotation or forced rotation by the yen exploding higher, it doesn't matter. You got a rotation, and the money comes out of the winners, the big caps and the chips, the over-positioning that we have. Number two, we have NVIDIA's earnings. And if that name blows up, for whatever reason, missing the numbers are too high, there's a peak in earnings, the bar is set way too, whatever reason it is. If NVIDIA goes down, it drags everything down with it. The third reason could be technical in nature, because you have the NASDAQ, the Qs, those are the laggards still. The S&P, the Dow Jones, even the IWM getting close. The value ETFs, all of them are at the highs right now. The NASDAQ, the index, technology, chips, not close. And that could be a sign of weakness, relative weakness. So I said also in my notes before I finished Friday, you gotta watch out for these bearish engulfing candles. We got one this Thursday. We closed within the body of the candle Friday. I pointed out the fact that we have consolidation after major bearish engulfing candles. And then we see a flush down after. Few days of consolidation, then we go down. What is the reason behind that? Well, the bearish engulfing comes from the big guys who bought earlier. They rode the wave of this rebound. They book their profits. They say, okay, enough. We've seen enough. There's a lot of risk here. Why not just book some profits? We see big flush downs, leading the creation of a bearish engulfing candle. But after that, we wait for further feedback. You got a shock. And now we're waiting for buyers. The sellers are gone. Now do we have any buyers in the sidelines? And hence the consolidation. If the buyers don't show up because they're too scared, then another batch of sellers who are still profitable will come in and say, okay, you know what? I think maybe we have a lower high here. I think maybe the rebound is over. I want to book my profits too. And then the sellers show up, we see the bearish engulfing candle playing out. That is the psychology behind the chart. Anyhow, adding more color to this conversation, let's segue to the market activities, beginning with the closing of the indices last Friday. And here we go. The diamonds up by 462.28 points, or a gain of 1.14%. And the NASDAQ not leading the pack, although nice gains here, 258.44, or a gain of 1.47%. Now the Spider was up by 63.97 points, or a gain of 1.15%. And the leader of the pack, the rotation of risk on, the Russell 2000 small caps, up by 6.82 points, or a gain of 3.19%. Looking at these sectors on Friday, everything is in the green. Gains across the board. Everybody who wanted a narrative, any bullish narrative you're looking at, you got it from the Fed. You got something you can play with. Whether that's going to be real or not, or sustainable or not, at least on Friday, you could have made up any bullish narrative you wanted to look at based on the comments we got from Jackson Hole. In contrast, look at the performances for the week. Really similar, but it is notable that technology, which was at number 2 in Friday's session, now comes down closer to the bottom on the weekly look. But real estate maintains its supremacy. And the reason is it's dividend paying. Doesn't matter which fears we have. Recession, rotation, inflation, Fed is going to say whatever, it doesn't matter. The dividend paying stocks did pretty good. You see that in healthcare, you see it in defensives, you see it in utilities. They've been reliable so far. And there are rotations within these sectors too, but all in all, they maintain a good lead. Looking at the breadth, excellent across the board. You got 91% advancing versus 8% declining in the NYSE. You got 77% advancing versus 21% declining in the NASDAQ. But most importantly, the new 52-week highs overwhelmed the new 52-week lows. And this is a signal that we have a rotation. The gains are led by the rotation. That was good for Friday's session. Looking at the map, this is Friday. Pretty much everything is in the green. You have some exceptions here and there, but these are related to earnings and analyst upgrades and downgrades. But besides that, if you bet on anything Friday, it went higher because, again, you could have made whatever narrative you wanted to make. If you were in the dividend cohort, you would have made an argument. If you're in the risk on, you would have made an argument. Risk off, same thing. So anybody could have came out with a narrative, a bullish narrative, where we can play and push these names higher, whichever corner you desire. In contrast, looking at the weekly heat map, not much different. In the beginning, though, we got a lot of recession fears. We've seen oil getting hammered. So despite the rebound on Friday, oil closed the week negative. We see certain names and chips beginning to diverge. While NVIDIA closing positive, Taiwan, Micron, Intel, the equipment manufacturers, ASML, AMAT, Lam, all in the red for the week. And the question now becomes, are they wrong and NVIDIA right? Which will be proven by the earnings report we're getting this week. Or are they sounding the alarm ahead of time that maybe NVIDIA is peaking since they've reported earnings beforehand? This is why this week is important. My 2 cents, I think that these names are pointing out to slowdowns and peaking that we will see in NVIDIA too. But again, throughout the week, folks, if you wanted to make a bullish narrative in any corner that you like, be it healthcare, be it dividend, be it real estate, be it metals, be it the cyclicals even, be it the banks, you could have made that narrative, and hence the rotation was doing pretty good. On the other hand, you look at the mega caps, the Amazons, Metas, Apple, Microsofts, they're pretty much flattish because the money did not chase these guys. It came out of these guys just a little bit. You got Google, on the other hand, closing positive. That's, of course, we talked about the elections and the spending that's going to happen. $500 million. A lot of that will be in the pockets of YouTube and Google. When we look at the weekly heat map for the ETFs, again, it looks green across the board, but who gains over who? We got the TLT up, so yields were down, rate cuts, but the market says for the good reasons now. Not only that, we're getting more of them, so if there was any recession risk, we're not worried about it anymore. So it is notable that the leader was, once again, the rotation, as we talked about in last weekend's video. The IWM, mid-caps, even value, beating, outperforming the mega cap companies in the XLK and the chip companies in the SOXX. The higher the risk in the rotation, the better the performance. So you got the XHB home builders leading the pack, highly sensitive to the economy, the ITB construction, the KRE regional banks, and the XBI biotech. So we see the evidence from the rotation. Now, a lot of these rotations, when you look at a map like this, you got to distinguish and say, which rotation do I like? And I see sustainability. I'm going to stay along those. What rotations I don't like? But I think they might have leg for a few days, a few weeks. Those I'm going to rent. Which ETFs and segments of this map that would suffer from such rotation and changes in the macro and the Fed commentary, and perhaps from earnings, be it NVIDIA? I think it's the big caps, and I think those are the chips, and this is why we say those hedge, sell, or short. Enough said. Moving on to commodities. Look at what happened on Friday's session. If you think that the inflation risk is eliminated, and on Friday's session, we just got the promise of rate cuts, and we're just going to rally upon that. You're going to be proven wrong, and the reason is, look at the performances that we've seen in the commodities cohort. The same promise of a rate cut initiates a rotation that includes commodities, most of the time led by commodities. So you see crude up about a little over 2.5%, Brent a little over 2.25%, the gasoline RBOB gains of almost 2%, heating oil up a little over 2%, and the laggard, nat gas, down about 8%. A lot of the money in natural gas now rotating into crude, and the reason is we got a signal from the dollar going down big that, hey, we have a risk-on rotation, which includes the energy names, includes commodities. You look at softs, green across the board. The exception is lumber, down about 3.5%, but sugar up 3%, cotton up 2%. And remember, I'm eyeing an entry here in sugar. I need to see a little more. Coffee got some bad news from Brazil, but it closed positive Friday, and it might continue to move higher. It is certainly one of the best looking charts in commodities right now. But when the dollar goes down, and this time around for the good reasons, that's what the market thinks. We also see gold, silver, platinum, copper, palladium, all of the metals doing okay. But you gotta remember that even with yields going down for the wrong reasons, for recession reasons, oil was down, a lot of the softs were down, a lot of the metals were down, copper was down, but gold continued to hold and move higher. So it is tested and proven under each scenario. And this is why you see gold has better resiliency. So when you play these rotations, you got to pick the higher qualities. The stuff that's not higher quality, you rent those, and then when they're done, they're done. You look at grains, gains for soybeans, soybean oil, although we see a pullback in corn and wheat. All in all, for the week, what do we see here? The leaders, cocoa, OJ, lean hogs, cotton, soybean oil, silver, and the laggards, natural gas, lumber, and wheat. Again, among the charts that we discussed over the week, gasoline RBOB with the falling wedge now breaking out. But would it finish a move higher here and initiate more buying, more short covering as the dollar continues to go down? Gasoline RBOB, that's the price at the pump, which recently has dropped dramatically. It might make a comeback as we play the risk-on rotation. We also looked at soybean oil, and again, falling wedge, breaking out, confirmation in the MACD. So this is a chart that we want to ride all the way to 41.39, where we find some resistance and then see what happens. If we cross above, then we'll probably continue to move higher. If not, and we pull back, then there still would be the possibility of an inverse head and shoulder pattern, but one step at a time. Moving on to the big casino options market, what do we see here? Believe it or not, the volume's still down. The traders are gone. They never came back. Since that day of the Japanese yen problem, they're gone, never came back. And we gotta be suspect of why. Hesitancy, lost their money, what's going on here? But we see volumes in NVIDIA and Tesla. The IV ranks in both are beginning to move higher. indicating higher volatility to come. And we see the bets for puts beginning to pick up here, at least in Tesla a little bit. Still in the high 30s in NVIDIA. My hunch is as we get to the report this week, we'll probably be in the 60-40 spread between the calls and the puts. But folks, once again, if we're going to go down from this point on, look at how cheap the IV rank is across the board. Amazon with a 12% IV rank. Marathon Digital, only about 3%. You look at names like Palantir, like Coinbase. If we have a little bit of volatility and a downside coming in the market really soon, the entry at these points are really, really attractive. The problem is they come with a downside, that we might see the floating higher operation or another pop higher in the market. Then your entry is wrong and I'm going to fix it or abandon it. So if you want to wait for confirmation, we're going to do that in the charts analysis in a minute. But before we do that, what about the bullish versus bearish flows when it comes to the buy side? They're buying calls on UPST, Upstarts Holding, MicroStrategy, TLT, Amazon, Coinbase, Meta, NVIDIA, Triple M, and the TQs, the bullish levered index for the Qs. They're buying puts on Intel, Snowflake, bonds, the bullish levered index for the SOXX, that is chips, AMD, the indices, SPY, SPX, Chevron. Now in the selling flow, they're closing puts on Intel, crude oil, Snowflake, Boeing, Lean Hogs, Disney, Chevron. So they closed about $2.3 million in puts, but they opened about $1.8 million in new puts from the buy side. So here, since the numbers are really close, we can speculate that a lot of the winning puts are now booked and they're rolling down. So it is still bearish, but it's not as bearish as it used to, since the closing of the calls flow exceeds the buying of the puts flow. In any case, they're closing calls in Triple M about $23 million. But remember, in the bullish flows on the buy side, they bought about $13.5 million. So again, not as bullish as they used to, but they're still rolling, at least some of them. They closed calls on MicroStrategy, on the SPY, on Apple, on EVH. This is for Evolent Health, one of the most violent, or shall we say volatile, names in the last couple of weeks. What about the unusual activities that we got on Friday? We begin with the bullish ones, FCX Freeport McMoran, aka copper. Somebody has a long combo. Highly bullish because you're selling a put at the 38 level. So you say that if the stock goes below 38, it'd be a steal. So I'm going to sell those puts to buy more of FCX. I'm also going to buy the 45 calls, same expiration date, October 18th. So if the stock doesn't go down below 38, if there is no pullback and we continue to go higher, I'd love to ride the momentum all the way to 45 because we'll be above 45 by then. And this is why we call it a combo, because you're buying on both sides. One via the calls, one via the puts. When you exercise, of course, that means you're highly bullish in the equity. We also have calls for TSM Taiwan. Somebody bought the 175 calls, the expiration date, November 15th, spending about $9.5 million. You gotta take note of that. And then we have Amazon. This is also bullish, buying the 180 and the 195 calls for the expiration date, October 18th, spending about $3 million. So somebody says that the rebound in Amazon will continue. We'll find more buyers, not sellers. And then we have BAC long calls for Bank of America. Now, we know that Warren Buffett been dumping recently, and it impacted the price action of BAC negatively. But we found buyers at the end of the day, and the upward trend was not lost. If you look at the weekly chart for BAC, the chart reclaimed its bullish trend line. So here we have somebody who says, nope, we found buyers, and I think that BAC been lagging because of the Buffett news. But it should be trading with JPM and Wells Fargo moving higher. So they bought the 42 calls, the expiration date October 18th, spending about $1 million in those. And then we have another bullish one for you here for the TLT bonds. Now, whether that's going to be bullish for the market or not, we have to ask, why do we see TLT going higher? Why do they see the TLT going higher? Whoever is betting on this bet right here. Is it because they rush to safety in buying bonds, and that's going to be because of recession news? Oh, that's not a good TLT going higher. Or is it because the Federal Reserve will cut rates more, and the market will look at it as, okay, this is going to be rate cuts for the good reasons? When we see TLT going higher, in that case, then equities will go higher with the TLT. Now, we have no idea who did the trade, so we can't really talk to them, but we can speculate. And in this case, they bought the 102 calls for the expiration date, Jan 1725, spending about $1.25 million. Let's segue to the bearish, unusual activities, beginning with INTC Intel. This is a short combo, so it is the inverse of the long combo that we just talked about in FCX. Here, we have somebody who's selling either way. They're buying the puts at the 20 line, The expiration date November 15th. And then they're selling the calls at 28, meaning if the tape goes above 28, they want to get rid of their shares at 28. Either way, they want to get out. They're not happy with the company. So we see this as highly bearish. They spent about $1 million on those. What about the puts on the SMH? This is the chip index, heavy with NVIDIA, the heaviest weight. So it's kind of a proxy bet against NVIDIA, I would think. In this case, they bought the 145 puts for the expiration date August 30, spending about $1.2 million. Let's move on to the charts and then wrap it up. We begin with the SPY, an hourly chart. What do we see here? On one hand, if I want to make a bullish argument, I would say no major support has been lost in Thursday's activities. 555, the important line that we talked about in last weekend's video, as the possibility of the resistance range, which acts as support right now because we're above. It has never been broken. That's still holding on. And we've been playing out bearish momentum if you look at the MACD indicator in the hourly chart. It's been playing out the bearish wave, the bearish momentum that we see in the MACD, while the chart been consolidating, which means that this could be a process of gathering energy and then moving higher again. All of that energy is released to the upside. And right now, there's a good case for the SPY to continue to move higher. And the reason is it has components where the rotation plays out. Sure, it is heavy with the Apples and the Metas and the NVIDIAs, but it also has other names that are going higher. On the daily chart for the SPY, what do we see here? Confirmations, beginning with the bearish, meaning you begin to short with no hesitation at all. If we lose 554.73, daily close below will be a signal to me is short. A bullish confirmation comes if we close above the previous high, not the previous meaning July, but the previous high meaning the day before, the top of the bearish engulfing candle. That comes all the way the high of 563.18. Closing above will be a confirmation that higher we go. The problem here is looking at the weekly chart for the SPX, the cash index, just in case some of you are trading the SPX instead of the SPY. It doesn't matter which one you look at. On the weekly chart, there's no time to fail. It's the James Bond thing. There is no time to die. You can't die right here. Because if you die, if you stop short of creating a new high, it'll be a confirmation of the top. It'll be a confirmation that the bullish wave is now ending. If you look at the MACD indicator, there is no time to die for any of these charts. If you look at the Qs, the hourly chart, holding on to trend, we see holding on to the important level of 473.82. Nothing really major was lost. A little bit of weakness Thursday, but now trading above all of the important numbers. We see the MACD indicator curling its way higher, about to form bullish momentum. There is a case where we can argue that the Qs will go higher regardless. We're just going to see it going higher. Of course, without a doubt, we're talking about the technical setup here. What could explain it is a fundamental catalyst, which is NVIDIA. What if that comes out good and we see a pop in the Qs? You gotta have your confirmations in the daily charts. And right now, the risk of overcommitment to one side versus the other, the bullish side or the bearish side, you could be proven wrong and lose a lot of money here. So it is a time where you might want to initiate certain positions up or down, but you're not going to go balls deep until you get your confirmation, and that's going to be on the bullish side, closing above 485.54. On the bearish side, closing below the 50 days moving average, right now sitting at 474.68. You get a break below or above, you make your move, because you got a confirmation. But again, folks, the problem is you look at the weekly chart for the NDX. This is the NASDAQ 100, just in case you trade the NDX, not the actual Qs. There is no time to die. You can't fail here, because if you fail, if you stall, you're doing a confirmation of a lower high. You're doing a confirmation of an inverse and a shoulder. You're doing a confirmation of the end of the bullish wave, which will descend down on the weekly chart, perhaps cross below zero. And that would mark the beginning of a bear phase. And that's not going to happen without the market going down 20-30% from the top. So we got to be really careful here. It is important that these charts don't die. Looking at the IWM daily chart, this one is okay. We can play with it so long as we have the narrative that we got on Friday going. We get any piece of macro data that says, no, the interest rate cuts that the Fed is promising right now, let's say the 50, not enough, because we have another piece of deep recession data. Or if we have inflation data, whatever kind of data that spoils the narrative, then we could see the IWM down. Otherwise, it might make the recent highs, around, let's say, 226.5. The momentum indicators are looking pretty good, the MACD, the RSI, but the narrative has to stay alive. And the sustainability of that going for too long is not really that reliable. Enough said. What about the dollar? We're now back at the lows from the fourth quarter of 23. The dollar is falling like a rock here. It's not funny anymore. At some point, we got to look at this as a sign of alarm. It is sending a signal. And the signal is, I'm going down for a recession. I don't care what the market says. There is going to be significant rate cuts here for a significant event, to mitigate a significant event. And that would be a recession. And the further the dollar goes to the downside, the higher the risk of margin calls from the yen firming up. Keep that in mind. The old man doesn't really care. If the dollar wants to go down, good reasons, bad reasons, doesn't matter. Gold is going higher. The GDX gold miners, if you want to go with that, that's okay for now, but it is more of the tradable side, not the own and hold. For that, you got to go with the actual commodity. You got physical gold or the ETF, GLD. You got to track the commodity, not the miners. If you want to trade, the miners are more lucrative. And right now, maybe we got to the top of the Bollinger Bands, got a little bit of a pullback. And now the chart is just readying for an ABC breakout. On Discord, we got a bullish trade in the GDX this week, and we closed this with triple-digit gains. We might be back on it again. If this is going to be an ABC breakout, then we might be back at the GDX table, baby. Now, what about the SLV Silver? Because it still has its fans and still has reasons to go higher if the dollar is going down. We talked about the inverse ABC pattern last week. It played out pretty good. Now we pulled back a little bit, lost the 50 for a while, 50 moving average in blue. But now we're above. The next step is closing above 27.24. Could be a breakout in ABC pattern, as we see in the GDX. So I'm okay with SLV2. Only problem is if the dollar rebounds. You gotta think about reasons why would that happen. You look at crude oil, light crude, daily chart. What do we see here? Above the resistance line, above an important resistance that stopped us at least 2 times, but short of the 20 days moving average in white. That is setting right now 75.40. If we close above, I think the risk of closing the gap at, let's say, 78.80 level again is highly likely. And if oil goes higher, I think it's going to be because of the rotation, the risk-off rotation, the assumption that right now the dollar and bond yields are going down for the right reasons. Looking at Exxon, weekly chart, what do we see here? It was volatile for the week. It was down big, then it rebounded really big. All in all, short of a close above 120. We want to see a confirmation that once it closes above 120 for the week, you got a breakout confirmation off a cup and handle. But boy, if we close below the trend line that you see in yellow, then the implications will be maybe we've gave up the pursuit of 120 and above. We're probably going to head down. And this is why the best way to buy ExxonMobil at this point is via call options. You do the 120s. If we close above, okay, you got the green light to buy. We got the all clear. But what if we lose the trend line? Then you know that you got to abandon these called positions. Not going to happen. But you didn't commit a lot of money buying the stock. In any case, looking at the 10-year yield, for now, it is holding the possibility of a higher low. We see a bullish breakout. Gee, why would that happen? Either good news for the economy, which the market would look at as good news, or is it going to be bad news from the inflation side, which the market will perceive as bad news? The only catalyst for that for this upcoming week would be the PCE report. I would say highly unlikely, but it is still a viable possibility. So keep that in mind. The bond market matters too. The bond market is what's leading all of this. Looking at the XHB home builders, the yield sensitive. And as yields go down for the right reasons, we see the XHB going higher. I said, folks, look, not my favorite rotations here because we're going to get recession data. That's not going to be good for the home builders. Or rates will go higher again, with it mortgage rates. And that's not going to be good for the XHB either. It loses either way. But right now, we got a technical rebound that is fueled by the rotation, and you can play with that. The IYR also breaking out. It was supposed to be a rising wedge, and you can see from the MACD that we got red impressions in the histogram ready to go negative. But then we got a pop Friday, and now we're extending the bullish momentum, and hence the big breakout. It was supposed to break down. Now all of that energy is released to the upside instead. The implications are that dividend-paying stocks work either way, whether you have a risk-on rotation or risk-off rotation. The good side of real estate would be the high-quality dividend-paying names. The highly risky side, which any rebounds would not be sustainable, perhaps opportunities to short, would be the higher risk component of the IYR. And that would be offices, medical properties, multifamily properties, REITs. Enough said. What about the KRE, regional banks? It is breaking out and perhaps leading the IWM to break out with it. Look at the MACD indicator changing from bearish to bullish. All of the energy of the consolidation below the 20 days moving average, let's say 55, is now released to the upside. We were long KRE for the week. We did a roll all the way to 60, so we think that the KRE has a little more juice to squeeze here. It can go to 60, if not even beyond, if the narrative doesn't change because of macro data, because of Fed talk, or because of earnings. If it is still intact, then the KRE will be a place to be. The VIX hourly chart, what do we see here? No breakout. We got a breakdown instead. The breakout was closing above 1760, then 20 becomes in the bag. Never happened. Now we lost 16. This is an important support line. evident by the recent rebounds 3 times. We found buyers at 16. So if we lose 16, it is saying that a lot of these buyers, a lot of the hedging is now being taken off the table. Maybe because we feel a sense of security Friday. Whether that's going to be false sense of security or a plausible sense of security, who knows? But right now, a touch negative for the VIX. It can trade above 16 easily, but it closed below was certainly among the negative for the VIX, bullish for the market. Now we'll look at the weekly chart for the VIX. What do we see here? No violation of the 20 weeks moving average. So if we continue to move higher from this point on, the risk of an ABC breakout will be highly likely. Looking at the big kahuna apple, what do we see here? The rising wedge broke, leading to consolidation for now. There is no major break below support or above resistance for now, but we know that momentum is weakening. We're looking for the sellers to say, okay, we've made enough for the rebound now. We lost a little bit when Buffett dumped, and now we're back. So let's book some profits. What are they waiting for? They're waiting for a new batch of dummies. We're going to think that this is an opportunity to buy Apple right here. And they hop in and cause a breakout. Then they don't need to sell it. But if those buyers don't show up really fast, the sellers are they're going to notice it. Somebody's going to push the button. And then the tape goes down. And then others begin to push the button too as they hit their close target or the stop loss target. And we see a big flush down. So right now, really frustrating for Apple, but there is a major break coming. There's a big move coming here. The souffle Tesla above the 50 again, 50 in blue, within the body of the bearish engulfing candle. So it is not out of the woods yet. It'll do that once we have a closing above the top of the breakdown candle, let's say at around 224.16. If we have a close above, all of the confirmation we need, the higher we go. You look at the daily momentum in the MACD, that's moving higher. Now, if we take the lows of the candle again, the breakdown candle that is from Thursday, we lose the 50 with that because it is a requirement to take the lows of the breakdown candle. If we do that, we're going to get a confirmation that no, down we go. And we got an I-200 as the next target to look at. What about NVIDIA hourly chart? What do we see here? We talked about the falling wedge pattern in Thursday's video. We got a break out of it, but no failure so far. Would love to see a failure. Just take a little bit of air out of this baby right here. That's also going to give us clarifications on how to trade NVIDIA before the report comes out. What do I mean by that? I mean that if we have a loss of 120 or better yet 117. Now zoom out to the daily chart. I mean 120 will do the job, but 117 will come as a confirmation if we lose that. But we have a bull flag pattern right now above the trend, and we could see a break to the upside. To eliminate the possibility of the bull flag, you got to trade below the bottom, the breakdown candle, aka the bearish engulfing candle that we got on Thursday. A 120 will be enough to do that. If we do it, there is no risk of a bull flag. So you can trade it here with perhaps a little more bias to the downside, not the upside. Because if we close like this, the bias, at least from a technical lens alone, would be, hey, this is a bull flag above all of the important numbers, all of the important moving averages. You got to assume it goes higher. So the move into earnings will be really important. Does it eliminate or keep the bull flag risk? And lastly, tulips. What do we see here in Bitcoin? Above the 200 now, 200 in yellow, and above the 50 in blue. The technical lens says bullish breakout, and you have the bull flag pattern. Next stop, 67,000. When do we say that we're wrong? If we lose the 200, better yet, if we lose the 50. The 50 moving average right now is sitting at 61,000. 932.88, let's call it 933. So if we lose that, okay, we get a failure. But right now, the odds for a break and a revisit to 67,000 carries the better odds, at least right now. Let's wrap it up already, folks. Conclusion. What do we have on the economic calendar this week? We have plenty. And since the market right now is in tune to the macro data, sensitive, it changes moods one day after the other based on the flow of the macro data. Monday, the 26th, we have durable good orders. Tuesday, the 27th, we have the Case-Shiller Home Price Index. A little lagging, but also an important piece of data. Then we got consumer confidence. Wednesday, the 28th, we have the zombie from Atlanta, Bostic. That's about it. Then we got Thursday, the 29th. It heats up a little more. We got initial jobless claims. We got trade balance in goods, retail inventories, wholesales inventories. The GDP data, pending home sales, and once again, another session with zombie from Atlanta, Raphael Bostic. And lastly, we close on Friday, August 30, last day of trading of the month. We got the PCE, personal income, personal spending, core PCE, aka the Fed's favorite inflation indicator, that comes on top of the Chicago Business Barometer and the final reading of consumer sentiment from the University of Michigan. Important week. And knowing the steps and studying history and knowing the kind of mood swings that the market will be in right now is critically important. I just gave you a course. This video is a course. So if you did like it and appreciate the information, please return the favor by pressing the like button, subscribing to the channel, leaving a nice comment in the section, Better yet, why not join us as a member? Access to the daily videos, bonus videos, either here on YouTube or Patreon. Links in the description. But with that, folks, good luck trading next week. A lot of stuff to look forward to. But now you know. And this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
You make your own reality. And once you've done it, apparently, everyone's of the opinion it was all so fucking obvious. Lunch!